Welcome to the Deep Dive. Today, we're plunging into the bond market. Now, that might sound a bit dry, maybe,
Yeah, I can get that reputation.
but trust me, if you really want to get a grip on how the global economy works, even your local economy, this stuff is, well, it's crucial.
Absolutely.
Think of this as your, rapid immersion course. We're
Yeah.
aiming to pull out the vital knowledge so you can understand it quickly, get up to speed fast.
Exactly. We've sifted through a pretty detailed guide aimed at beginners, actually. And our mission today is to make it all clear and, relevant for you listening.
Right.
We know it seems complicated sometimes, maybe even intimidating, but we're here to just boil it down, get to the essential insight, the things that give you a real feel for what's actually going on.
Okay, let's do it. Starting right at the beginning then, what is the bond market in simple terms?
Okay, so at its core, the bond market is where debt securities trade, these things called bonds.
Okay, debt securities, so like loans.
Pretty much, yeah. Think of a bond as basically an IOU, a loan agreement.
Gotcha. And who are the main players doing the lending and borrowing here?
Well, you've got borrowers on one side. That could be governments, funding big infrastructure projects.
Like roads and bridges.
Exactly. Or corporations investing in new factories or research, even local councils financing things like schools.
Okay. And the lenders. Who's putting up the cash?
That's the investors. Could be individuals like you or me, maybe through a fund, or big players like pension funds, insurance companies, even other governments sometimes.
And how does the actual transaction work, the loan part?
So the investor gives money to the borrower for a set amount of time, a fixed period.
Right.
In return, the borrower pays regular interest. These are called coupon payments.
Coupon payments, okay.
And then when the bond matures, when its time is up, the borrower pays back the original amount they borrowed. That's the principle.
Right, okay. And I've often heard bonds called fixed income. Why that term specifically?
Yeah, that just highlights the steady stream of those interest payments, the coupon.
The predictable part.
Exactly. Bondholders typically get those payments throughout the bond's life, right up until it matures. So that consistent income stream is, well, it's a key feature. Lots of investors like that predictability.
Okay, makes sense. So this market, it's not some small, obscure corner of finance, is it? The source mentions some pretty staggering numbers.
Oh, absolutely massive. The global bond market is worth, well over $100 trillion.
Wow. $100 trillion?
Yeah. And to put that in perspective, it's actually bigger than many global stock markets combined.
Yeah.
So that really tells you how fundamental it is to the whole financial system.
And is it just one big market? Or are there different types?
Good question. There are really two main parts. First is the primary market.
Primary.
That's where new bonds are sold for the very first time. So imagine the Irish government needs funds for, say, a new hospital. They issue new bonds there.
Like brand new bonds.
Exactly. Then you have the secondary market. That's where investors trade bonds that have already been issued. So buying and selling existing bonds. And actually, most of the action, the vast majority of trading, happens in the secondary market. Bonds change hands all the time based on, economic news, interest rate changes, all sorts of things.
Okay, got the market basics, the players, the deal. Now, let's get under the hood a bit more. What are the different kinds of bonds we should know about?
Right, there's quite a range. Let's start with government bonds, probably the most well-known.
Okay.
These are issued by national governments, generally seen as lower risk because, well, they're backed by the government's power to tax people or even print money if they absolutely have to.
Right, like U.S. Treasuries or Irish government bonds.
Exactly those. Classic examples. Considered very safe, usually.
Makes sense. What other types are common?
Then you've got corporate bonds, issued by companies
Why do they issue them?
to raise money for things like expanding the business, funding R&D, maybe buying another company. They
Right.
generally carry a bit more risk than government bonds. So to make up for that extra risk, they usually offer higher interest rates, higher yields. The specific risk depends heavily on the company itself, its financial health.
Got it. And what about local governments? Like cities or counties?
Yep, those are municipal bonds, or munis sometimes, issued by local governments or related agencies, usually to fund public projects, schools, hospitals, roads, that sort of thing.
Okay. Sovereign bonds, that sounds like governments again, but different.
Yeah, exactly. Sovereign bonds are still government bonds, but they're issued in a foreign currency, often by emerging market countries.
Ah, okay. So Potentially higher returns, but maybe more risk.
You got it. They can offer higher yields, but you've got extra risks like currency swings and the economic stability of that specific country.
And finally, I've definitely heard the term junk bonds. What are those?
Right, or the more polite term is high-yield bonds.
High yield. Okay.
These are issued by companies or sometimes governments that have lower credit ratings. That means there's a higher perceived risk that they might not be able to pay the money back. Default risk.
So why would anyone buy them?
Because they offer much higher yields to compensate investors for taking on that extra risk. High risk, potentially high reward.
Okay, so a whole spectrum of bonds then. Now, if you're looking at one specific bond, what are the key details, the characteristics?
Several crucial things. First is the face value or par value.
Face value.
That's the amount the borrower promises to pay back to the investor when the bond matures. The principal amount. Often it's like $1,000 for U.S. corporate bonds or maybe $1,000 for Irish government bonds.
Got it. The lump sum at the end. What else?
Then there's the coupon rate. This is the annual interest rate the issuer pays. It's usually expressed as a percentage of that face value.
Right. So 1,000 euro of bond with a 5% coupon.
Means you get 50 euros in interest each year.
Exactly.
And how long does this go on for? The bond's lifespan.
That's the maturity date, the date when the principal is repaid. Bonds can be short-term, maybe 1 to 5 years, medium-term, say 5 to 10, or long-term 10, 20, even 30 years or more. Okay. And lastly, yield. How is that different from the coupon rate? They sound similar.
Good point. They are related but different. The coupon rate is fixed based on the face value. The yield is the effective return you get as an investor.
Effective return.
Yeah, it takes into account the price you actually paid for the bond, which might be different from the face value, plus the coupon payments. And this is where that crucial inverse relationship comes in.
Okay, yeah, let's unpack that. The inverse relationship. Price goes up, yield goes down. Price goes down, yield goes up. Why?
Okay, let's use that example from the source. Say you have an Irish 10-year bond. Face value 1,000 euro, coupon rate 2%. So it pays 20 interest each year.
Right, 20 euro fixed.
Now imagine lots of people want this safe Irish bond, maybe because the economy looks shaky, demand goes up, so its price in the secondary market gets pushed up, say to 1,100.
Okay, costs more to buy it now.
Exactly. But you, the buyer, you're still only getting that fixed 20 euro payment each year. So your return, calculated on the 1,100 you spent, is now less than the original 2%. Your yield has dropped.
Okay. I pay more, so my percentage return is lower, even though the cash payment is the same.
Precisely. And the opposite is true too. If demand falls and the price drops to, say, 900, that same 20 annual payment represents a higher percentage return on your cheaper investment. The yield goes up.
So high prices mean the market expects lower future returns, and low prices mean higher expected returns.
You've got it. It's a really key concept for understanding market sentiment.
Makes total sense when you walk through it. So what causes these price swings? What drives the demand up or down?
Primarily changes in supply and demand, driven by a few key things. Economic uncertainty is a big one. When people are nervous, they often run to the perceived safety of bonds, especially government bonds.
So demand up, prices up, yields down.
Exactly. But when the economy is booming, investors feel more optimistic. Maybe they prefer stocks for potentially higher returns. So demand for bonds might fall.
Prices down, yields up.
Yep, that's the general pattern.
And how do investors figure out the riskiness of a specific bond issuer? Is there a system?
Yes, absolutely. That's where credit ratings come in. Big agencies like Moody's, S&P, Fitch, you've probably heard of them.
Yeah.
They analyze the issuer's financial strength and their ability to actually pay back the debt. Then they assign a rating.
Like school grades, A, B, C.
Sort of. It ranges from AAA, which is the top rating, meaning very low risk of default, all the way down to D, which means the issuer is already in default.
Okay. And where do countries like Ireland and the U.S. usually sit?
Well, as the source mentioned, Ireland generally has strong ratings, like A+ or higher these days, reflecting a stable economy. U.S. Treasuries are often rated AAA, considered almost risk-free in terms of default.
Got it. Okay, so we know what bonds are, who's involved, their features. Now, how does this massive market actually work day to day, the mechanics?
Right. It really functions through this network of key players we've touched on. You've got the issuers, governments raising funds, like Ireland's NTMA handling public spending.
NTMA, National Treasury Management Agency.
That's the one. And corporations, local authorities, all issuing bonds.
Okay. The borrowers. And on the other side?
The investors. And that's a really broad group. Big institutions like pension funds, insurance companies managing huge pools of money,
Yeah.
then individual retail investors, often through funds or brokers, and even central banks are major players. The U.S. Federal Reserve, for example, buys and sells treasury bonds all the time. That's a key tool they use to manage the economy, influence monetary policy.
And who connects the buyers and sellers? Makes the trades happen?
That's the job of intermediaries, banks, brokerage firms, and increasingly sophisticated electronic trading platforms.
Like stock exchanges, but for bonds.
Kind of, yeah. They facilitate the buying and selling, match orders, and crucially, they provide liquidity.
Liquidity, meaning
Meaning it's relative. Okay, number one is definitely interest rates. What central banks do matters hugely.
like the ECB in Europe for Ireland or the Fed in the US.
Exactly. Their decisions on setting interest rates have a massive ripple effect. Generally, if overall interest rates in the economy go up, the prices of existing bonds tend to go down.
Why is that?
Because new bonds being issued will likely offer higher coupon rates to reflect the new, higher prevailing rates. That makes the older bonds with lower coupons less attractive by comparison, so their price falls.
Okay, that makes sense. What about the general health of the economy?
Also crucial. As we said, strong economic growth might make investors more interested in riskier things like stocks, potentially lowering demand for safer bonds.
So prices dip, yields rise.
Right. But if a recession looks likely, investors often rush back to the safety of bonds, pushing prices up and yields down.
And inflation. Surely that plays a role.
Oh, absolutely. Inflation eats away at the real value of those fixed coupon payments over time.
Because the 20 you get next year buys less stuff.
Exactly. So if inflation is high, or people expect it to rise, investors will demand higher yields on bonds to compensate for that loss of purchasing power. That usually pushes existing bond prices down.
Okay. And finally, just the basic creditworthiness of the borrower.
Precisely. Credit risk. If investors get worried that an issuer, a company, or even a government might struggle to repay its debts, the price of their bonds will fall.
And the yield will rise to reflect that higher risk.
Correct. Investors demand a higher return for taking on more risk. That's why stable economies like Ireland and the U.S. typically benefit from lower borrowing costs, lower yields on their government debt.
Right. So the bond market isn't just about borrowing and lending money. It sounds like it's giving us signals, like real-time feedback on the economy's health.
That's a great way to put it. It's often called the economy's pulse. It reflects what millions of investors collectively think about the future, about growth, inflation, what central banks might do, their confidence, their fears.
Okay, let's dig into one of those signals you mentioned, the yield curve. What exactly is that?
Okay, the yield curve is basically just a graph. It plots the yields of bonds from the same issuer, usually the government, against their different maturity dates.
So yield on a 3-month bond, a 1-year bond, a 10-year bond, all on one chart.
Exactly. Short term on the left, long term on the right. And in a typical healthy economy, the curve slopes upwards.
Upwards.
Because investors usually demand a higher interest rate, a higher yield, for tying up their money for longer periods. There's more uncertainty further out, more risk of inflation eroding returns over, say, 30 years compared to 3 months. So they want extra compensation. That's a normal yield curve.
But it doesn't always look like that.
No, and that's when it gets really interesting for economists. Sometimes the curve flattens out short-term and long-term yields become very similar.
Okay.
Or even more significantly, it can invert. That means short-term yields are actually higher than long-term yields. The curve slopes downwards.
Short-term rates higher than long-term. That seems backwards.
It does. And historically, an inverted yield curve has been a pretty reliable, though not perfect, predictor of upcoming economic recessions.
Why? What does it signal?
It signals that investors are more worried about the near-term risks and expect interest rates and growth to fall in the future. They're basically saying, we'll accept lower yields long-term because we think things are going to slow down significantly. It shows a lack of confidence in future growth.
Our source gave some specific examples for Ireland and the U.S. yield curves. Can you remind us?
Sure. For Ireland, think back to the financial crisis around 2011. The yield curve was all over the place. Short-term yields shot up due to immediate default fears, and the 10-year yield hit something like 14%. Extreme stress.
And after the recovery?
Big change. By 2020, after bailouts and austerity, confidence returned. The curve normalized, and the 10-year yield fell way down, even below 1% for a while. Huge turnaround reflecting stability.
And the U.S.?
In the U.S., the Treasury yield curve inverted in 2019 and again in 2022. And, well, both times were followed by periods of economic slowdown or concerns about one. Looking at 2025, the source mentioned a steepening curve,
Steepening.
meaning longer-term yields are rising faster than short-term ones. That often suggests growing optimism about future economic growth, though maybe also some worries about inflation picking up again.
Okay. What about just the level of a government's bond yield itself, say the 10-year yield? What does that tell us?
It's basically the market's price tag on the risk of lending to that country. Low yields generally mean investors see the country as stable, creditworthy, low risk.
Like Ireland and the U.S. generally.
Well, yeah, relatively speaking. High yields, on the other hand, usually signal higher perceived risk, maybe concerns about debt levels, political stability, inflation.
And what were the approximate 2025 levels mentioned for Ireland and the U.S.?
For Ireland, being in the Eurozone helps. ECB support keeps yields relatively low. The 10-year was around 2–3% in 2025, according to the source. That suggests reasonable stability, confidence linked to foreign investment, the tech sector, etc.
And the U.S. higher.
Yeah, the U.S. 10-year Treasury yield was around 4% in 2025. That reflects stronger recent growth, but also the Fed raising rates to tackle inflation. And remember, U.S. Treasury yields are kind of the global benchmark. What happens there affects borrowing costs everywhere.
Right. Okay. Another indicator mentioned was corporate bond spreads. What's a spread in this context?
The spread is just the difference in yield between a corporate bond and a government bond with a similar maturity.
Okay, the extra yield you get for taking company risk instead of government risk.
Exactly. And that spread tells you about the market's overall appetite for risk, how confident investors are feeling.
So narrow spreads mean?
Narrow spreads mean investors aren't demanding much extra yield to hold corporate debt compared to safer government debt. They're feeling pretty confident about the economy and companies' ability to repay. Risk appetite is high.
And wide spreads.
Wide spreads mean investors are nervous. They want a much bigger reward, a higher yield, to compensate them for the extra risk of holding corporate bonds. Risk appetite is low. They're flocking to safety.
And the source mentioned examples, Ireland and the U.S.
Yeah, in Ireland, spreads for strong companies like, say, Ryanair were mentioned as being relatively tight, suggesting confidence in the corporate sector there. In the U.S., spreads widened a bit in 2024 when recession talk was louder, but then stabilized somewhat as those fears faded a bit.
Okay. And finally, how does all this bond market activity reflect foreign investment? What other countries think?
It's a pretty good gauge of foreign investor confidence. If foreign investors are buying lots of a country's bonds, it suggests they feel positive about its economic prospects and stability.
Like Ireland attracting capital.
Exactly. Its Eurozone membership and stable environment attract foreign money into its bond market. And for the U.S., treasuries are seen globally as a super safe asset. Countries like China and Japan hold trillions of dollars in U.S. debt.
Which helps keep U.S. borrowing costs down.
Right. That strong foreign demand is a key factor.
Okay, let's zoom in specifically on Ireland's bond market for a moment. What are its key features?
Well, compared to the U.S. or global market, it's relatively small, but still very significant within the Eurozone context. It's dominated by government bonds managed by that agency, the NTMA.
The National Treasury Management Agency.
Yep. And the outstanding government debt mentioned for 2025 was around $230 billion.
And what were the main points highlighted about Ireland's market?
Well, that post-crisis recovery is the big story. How yields went from sky high during the crisis down to very low levels afterward, thanks to austerity, bailouts, and eventually recovery.
And strong credit ratings now.
Exactly. A+ or higher by 2025, meaning Irish bonds are seen as pretty safe now. The second key point is the massive influence of the Eurozone and the ECB.
European Central Bank.
Right. Their monetary policy, especially keeping interest rates low for a long time, really helped Ireland manage its debt and support its export-driven economy. And finally, those stable low yields are an indicator of Ireland's resilience, driven by foreign investment, the tech sector.
But still exposed to global risks.
Oh, definitely. Like any open economy. Changes in global trade, for instance, could definitely impact Irish yields.
Okay, now let's switch to the giant. The U.S. bond market. What are the absolute must-knows about it?
It's the biggest in the world. Simple as that. Dominated by U.S. Treasuries, over $30 trillion outstanding debt mentioned. Its size means it basically sets the tone globally.
A global benchmark.
Absolutely. When U.S. Treasury yields move, the whole world watches and often follows. The rise in U.S. yields in 2025, driven by the Fed fighting inflation, directly increases borrowing costs for countries and companies everywhere.
And the yield curve signals.
It's hugely important. The U.S. yield curve is probably the most closely watched economic indicator on the planet. That steepening curve in 2025 suggests growth optimism. But yeah, inflation is still the big question mark causing potential volatility.
And it's not just treasuries.
No, it's incredibly diverse. You've got treasuries, a massive corporate bond market, think Apple, Tesla, issuing debt, plus municipal bonds. It attracts investors from literally everywhere.
Okay, so we've covered a ton. Fundamentals, indicators, Ireland, the U.S. Let's bring it back to the listener. Someone who just wants to be well-informed, maybe not a finance pro. Why does any of this matter to them, really?
That is the key question, isn't it? And I think there are a few reasons. Even if you never buy a single bond yourself,
Right.
understanding the bond market gives you vital context for the economy you live in. For investors, even conservative ones, government bonds can offer safety, a low-risk option.
Capital preservation.
Exactly. And bonds offer that predictable income stream, those coupons, which stocks don't always do reliably. Plus, they're great for diversification, balancing out the risk in a portfolio, especially when stocks are rocky.
Ooh.
But maybe most importantly for the listener, just wanting to be informed quickly, tracking bond yields, just knowing whether they're generally going up or down, gives you a powerful real-time window into big things like inflation trends, growth expectations, what central banks are thinking.
So it helps decode the economic headlines.
Precisely. It helps you understand the forces shaping things, even if you're not directly involved.
That really clarifies why it's worth paying attention. Any quick practical tips for beginners who are curious, maybe want to learn a bit more, or even try investing?
Yeah, a few things. First, maybe start small and diversified. Look into bond funds or ETFs, exchange-traded funds.
Like the iShares Treasury ETF mentioned, or Irish bond funds.
Exactly. They hold a basket of bonds, so you get diversification without picking individual ones. Second, understand the risks. Government bonds are safer, yes, but corporate bonds have default risk. Always check those credit ratings.
Makes sense.
Third, keep an eye on yields. Use resources like Bloomberg, financial news sites, or the official NTMA website for Ireland. Just tracking the trends gives you those insights we talked about.
Get a feel for the direction.
Yep. And finally, maybe learn a couple of key terms if you get more interested.
Wow.
Things like duration, which measures how sensitive a bond's price is to interest rate changes, and convexity, which is related to that. But start with the basics.
Okay, great advice. So as we wrap up this deep dive, what are the absolute core takeaways, the main things to remember about the bond market?
I'd say number one, it's fundamental, a pillar of the global economy.
Yeah.
It's how governments and companies fund themselves on a massive scale.
Okay.
Number two, it's a critical economic barometer. It tells us so much about economic health, expectations, risk appetite in places like Ireland, the US, and globally. And number three, understanding the basics, bond types, yields, that inverse price yield thing, what yield curves are signaling, gives you incredibly valuable insight into those bigger economic trends.
So ultimately, even just a basic grasp empowers you, the listener, right?
Yeah.
Helps you understand the bigger picture, make more informed sense of the news, even if you're not trading bonds yourself.
Exactly that. It connects the dots. So maybe a final thought to leave people with.
Yeah.
Consider that interconnectedness, how U.S. Treasury yields ripple outwards, how Eurozone policies affect Ireland, how tightly linked these global bond markets really are. And then think about what big global events, maybe geopolitical shifts, tech breakthroughs, climate change responses, what could really shake up these markets in the future? And what would the knock-on effects be? Something to ponder.